Now that we know that the equity of the subsidiary will have to be attributed to more equity participants than merely the ordinary shares like we've been doing up to this point, we can further unpack the preference shares of S and the effect they have on the consolidation process. If the parent company did not acquire any preference shares in the subsidiary, the total equity of S that is attributable to the preference shares will be attributable to non-controlling interests. The parent remains the parent. That can only be one entity. But the parent is determined with reference to control and from the investment in ordinary shares. So the parent can end up not having any investment in the preference shares of S. Then we know that all the equity participants other than the parent is collectively grouped together as my non-controlling interests. Then the equity of the subsidiary that is attributable to the preference shares is fully attributable to your non-controlling interests. The reason why we have to distinguish between the equity participants is because the percentage holding, as you would have seen in the previous slide, the percentage holding in the preference shares does not have to correspond with the percentage holding in the ordinary shares. And because the percentage holding is different, you have to split the equity of the subsidiary out into the equity attributable to the ordinary shares so that you can attribute that based on the respective percentage shareholdings, and into the equity attributable to the preference shareholders so that you can attribute that in accordance with the percentage holding. From these discussions, you can now gather that we need two analyses of equity. And part of the analysis of equity is to determine the amounts for purposes of writing the at acquisition consolidation journal entry. So the moment you have two classes of equity participants, you have to also write two at acquisition consolidation journal entries. Still talking about non-controlling interests. What happens at acquisition date? The non-controlling interest in the ordinary shares, we had the option to measure them either at their fair value or their proportionate share, because the ordinary shareholders is entitled to a portion of the net assets of the subsidiary should the subsidiary liquidate. But if you have preference shareholders, your at acquisition date preference share NCI can only be measured at fair value. You cannot measure them at proportionate share because your preference shareholders is not entitled to a pro rata share of the net assets of the subsidiary at liquidation. Remember when we spoke about the nature of preference shares, your preference shareholders will only be entitled to their capital upon liquidation. So this is something you have to look out for when you do the examples, is that for your preference share NCI, you can only measure them at fair value, which is an amount that we have to give you in an example. Now, the moment you have two at acquisition consolidation journal entries where you eliminate the equity of the subsidiary against the investment by the parent as common items and you recognize NCI as a new item, you will also recognize goodwill or gain from bargain purchase. Now, it can happen that you have goodwill from the elimination of the ordinary share equity and a gain from bargain purchase when eliminating the preference share equity against the investment and recognize NCI. Or you can have goodwill in both, or you can have gain from bargain purchase in both. There's no set rule, but the principle is that you only present one goodwill or one gain from bargain purchase amount in the consolidated financial statements. So if you have goodwill from the one at acquisition consolidation journal entry and a gain from bargain purchase from the other, you first have to offset those two amounts against each other before you present one net amount in the consolidated financial statements. When we do the examples in Chapter 8, you'll see the effect of this. Still talking about the effect that the preference shares of the subsidiary will have on the consolidation process. If you have more equity participants, more shareholders, there's more dividends to be declared. The preference dividend that will now have to be declared to the preference shareholders of S will also be regarded as an intra-group dividend, and it also has to eliminate. The principles behind the preference dividend declared by S, it being a negative movement in the equity of S, is exactly the same as what we've already discussed in Chapter 4 when we looked at the ordinary dividend declared by S. When the subsidiary declares a preference dividend, it will also have to eliminate as part of the consolidation process. Up to date, how did we measure NCI? For NCI in ordinary shares, we measured them at acquisition date, and then we have attributed a portion of the since acquisition date equity of S to my NCI, both for since to opening balance period and for the current year movements. Now you have to measure NCI in the ordinary shares and NCI in the preference shares of S. They will all still collectively be one line item for non-controlling interest in the consolidated financial statements, but you have to prepare two analyses of equity, one for the ordinary shares and one for the preference shares. And your whole purpose behind the two analyses is to take the equity of S in the TB and split that out into the equity attributable to the ordinary shares and the equity attributable to the preference shares. The reason why you have to split it out is because when you start attributing, you attribute that based on different percentage holdings. The parent in the ordinary shares can have a different percentage holding in the preference shares compared to its holding in the ordinary shares, and that would have the same effect on the NCI's percentage holding. Right, so if you now have to prepare two analyses, how do you do that? As I've said, your starting point is still the total equity of S from the separate trial balance. That will never change. Then the ordinary share capital included in the total equity of S will only be in the ordinary share analysis. That is only attributable to the ordinary share equity participants. There is now new equity, which is the preference share capital of S. That will be included only in the preference share analysis because it's only attributable to the preference share equity participants. But something like retained earnings, it's still only one amount, one TB opening balance for retained earnings, one profit for the year, all being part of the movement in the equity of S. And now that one retained earnings amount needs to be attributed to both the ordinary shares and the preference shares. And how we will do that in the analysis is to ask how much of that retained earnings that's allowed to be in the group, the since acquisition date movement, how much is attributable to the preference shareholders? How much are the preference shareholders entitled to? And then the portion that is attributable to the preference shareholders will be moved out of the ordinary share analysis to the preference share analysis. What's left in the ordinary share analysis for that retained earnings will then be attributed to the ordinary share equity participants, and what you've moved out to the preference share analysis will be attributed to the preference share equity participants. Now, when we do this, when we determine how much the preference shareholders are entitled to, is highly related to the fact whether it's cumulative or non-cumulative preference shares. The portion attributable to the preference shareholders will be determined whether it's cumulative or non-cumulative.